In this lesson, we will discuss economic concepts, macroeconomic concepts that influence our planning assumptions and projections. By the end of this lesson, you should be able to understand core economic concepts, including money supply, the gross domestic product, GDP, fiscal and monetary policies, and economic indicators, describe business cycles, and discuss the impact of interest rates and exchange rates on financial planning and purchasing power. So why is it important to understand core economic concepts such as GDP, interest rates, unemployment, and business cycles? David Yeske, an author in the CFP Board's Financial Planning Competency Handbook, Edition 2, suggests the following. They help us develop reasonable assumptions for financial projections. They help us explain the implications of economic conditions to clients and establish reasonable expectations. And they help us form appropriate judgments about the direction of the economy for planning purposes. Let's begin by discussing the economic concept of opportunity cost. Opportunity cost refers to the valuation of alternatives. In other words, if the client decides on a course of action, what is lost by not choosing that next best alternative? In assessing value, you might consider the quantitative differences. What is the dollar payoff of the alternative? What income can holding an asset earn versus the cost of borrowing so that you can obtain that asset? You may also need to consider the qualitative benefits. Economists refer to this as utility, or units of satisfaction or enjoyment. For example, how does a client value a family trip to Europe versus saving that money for a new car? In assessing opportunity costs, you will undoubtedly be using the concept of time value of money. You'll learn more about this concept in your Financial Principles and Policy course. Supply and demand is a fundamental concept of economics. It's the dynamic by which markets clear. Supply is the quantity of goods or service that a supplier is willing to offer given a certain price. Demand is the quantity of goods or services that a buyer is willing to purchase given a certain price. The intersection of the supply and demand curves represents the equilibrium price. We may apply this concept when considering events such as a change in economic conditions or a proposed change in our planning fees. How do changing economic conditions impact the client? How will higher planning fees impact demand for my services? The National Income and Products Account, produced by the Bureau of Economic Analysis, is one of the main sources of data on general economic activity. One of the summary accounts is the gross domestic product. This statistic is a key measure used to estimate the growth or decline of the economy. It measures the total market value of goods and services, final goods, produced by a country within a specific time period. One approach to measuring GDP is the expenditures approach. In this methodology, GDP is equal to the sum of consumption by households on durable goods, non-durable goods, and consumer services. Business spending on investment, including all final purchases for machinery and construction, and changes in inventory. Government spending, and net expenditures by foreigners. That's exports minus imports. Inflation is an increase in the general price level of goods and services. During inflationary periods, the real value of money declines as there is a loss in purchasing power. In other words, $1 no longer purchases as many goods or services as in prior periods. Moderate inflation is positive for national growth, and inflation tends to increase during economic expansions. The Consumer Price Index, CPI, is a basket of representative goods and services, and it often serves as a proxy for inflation. On the other hand, deflation is a general decline in prices. This creates a gain in purchasing power because that same dollar purchases more goods or services. Another way of saying this is that the real value of the cash increases. However, it should be noted that deflation has a negative impact on national growth, as evidenced by looking at the Japanese economy over a couple decades. Interest rates are determined by market rates of interest and the degree of risk. The short-term U.S. T-bill is considered risk-free and thus should have the lowest interest rate. Interest rates above the risk-free should be based on the degree of risk. For example, if you can earn 3% yield on a T-bill, then you should be compensated more to hold a C-rated corporate bond. The difference in yields represents the risk premium. Bonds are subject to interest rate risk. The amount of risk is dependent on sensitivity of the bond's price to interest rate change in the market. Two factors impacting the sensitivity are the bond's time to maturity and the coupon rate. You will learn more about risk and bond pricing in your Financial Principles and Policies class and your Investment and Portfolio Management class. The yield curve plots the fixed rate yield against term to maturity. For example, it will plot the fixed rate yield for the 5-year bond, 10-year bond, and 25-year bond for that bond of the same risk characteristic. For example, an A-rated debt. Typically, we see normal yield curves. The normal curve compensates the bondholder more for holding a bond with a longer maturity. During market peaks and early recessions, you may see the inverted curve, in which short-term securities are offered at a higher yield than long-term. This indicates that the market anticipates interest rates dropping in the future. The business cycle is a concept that describes recurring patterns of economic activity. These repetitive business growth decay or boom-bust cycles include periods of contraction or recession, the trough, which is the depression, recovery or expansion, and that peaking into the boom. The period of the cycle from recovery to peak is referred to as the bull market. During this period, interest rates rise, unemployment levels drop, and inflation rises. The flip side of the market, the peak to the trough, or the bear market, is characterized by just the opposite: falling interest rates, rising unemployment, and falling inflation. There are several categories of economic data that are periodically reported. These include employment, including payroll jobs, unemployment rates, initial job claims, help wanted signs, industrial production, GDP, industrial production, capacity utilization, durable good orders, consumption, retail sales, personal disposable income, consumer confidence, fixed capital investment, including housing starts, building permits, construction spending. Other categories include looking at inventories, the change in inventories, the level of business inventories, manufacturing inventories on hand, prices, costs, profits, the average hourly earnings, stock prices, commodity prices, money and credit, money supply, yield curve, the prime rate, the trends in interest rates, financial markets, the performance of the stock market indexes, the index of leading, coincidental, and lagging indicators. Composite indicators, including leading, coincidental, and lagging, help economists determine where the country is in relation to the business cycle. As noted on this slide, leading indicators tend to rise in advance of an economic recovery. Coincidental indicators tend to rise in tandem with the economy, and lagging indicators tend to rise near the peak of an economic cycle. 10 leading economic indicators are listed on this slide, and they are the average weekly manufacturing hours, the average weekly claims for unemployment insurance, new manufacturing orders for consumer goods, the S&P 500 stock prices, new orders for plants and equipment, building permits for private homes, vendor performance, index of consumer confidence, yield curve spread, and real money supply growth rates. Coincidental and lagging indicators are depicted on this slide. The coincidental indicators: non-agricultural employment, industrial production, personal income, manufacturing trade sales. And lagging indicators: change in consumer price index, the average prime rate, the average duration of non-agricultural unemployment, change in labor costs per unit of outcome, ratio of personal income to credit, ratio of manufacturing and trade inventories to sales, and outstanding commercial and industrial loans. So should the government manage the long-term growth and seek to reduce business cycle fluctuations? There are different economic schools of thought on this matter. The monetarists who promote Milton Friedman's theory argue that the Federal Reserve should actively manage changes in the money supply in order to maintain price stability. The advocate of John Maynard Keynes' theory argue that governmental spending and taxation should be used to create or reduce economic demand. Others say that both strategies should be used. Still others suggest that the economy should be allowed to self-correct, and the government interference is just counterproductive. The major components of fiscal and monetary policy are depicted on this slide. Fiscal policy includes government spending, management of the national deficit, and income tax collection and change. Monetary policy includes interest rates and money supply. Let's examine each of these policies in just a little more detail. Fiscal policy includes tax law, government spending, or not spending, and borrowing money to effect economic activity. This tool, which is used by the President and Congress, tends to be slow as it requires congressional and administration to agree. Monetary policy is used by the Federal Reserve to increase or decrease the supply of money. The Fed does this by setting the discount rate on short-term loans from the Fed to the banks, buying and selling U.S. Treasury bonds through open market operations, setting bank reserve requirements, which are funds that banks must keep on deposit with the Fed, and setting the margin requirement on loans by brokers to customers' margin accounts. There are different definitions, of money. M1 is the narrowest definition. It includes coins, paper money, and checking accounts. M2 includes M2 plus near monies, which include savings deposits, small time deposits, money market deposit accounts, and mutual fund money market accounts. And M3 includes M2 monies and large denomination time deposits and other less spendable assets. So what is the effect of expanding the money supply? Well, that depends on the situation. In normal economic circumstances, if the money supply grows faster than real output, it will cause inflation. In a depressed economy, central banks can increase the money supply without not necessarily increasing inflation. This occurred in our country between 2008 and 2011. An exchange rate is the change in the relationship between the dollar and other currencies. The changes occur 24/7, and changes affect investments and securities of companies doing international business. As the dollar gets stronger relative to a foreign currency, our goods and services become more expensive and foreigners become cheaper. As our dollar weakens against a foreign currency, our goods and services become cheaper and foreign goods and services become more expensive for us. In this lesson, you are introduced to numerous economic concepts, including opportunity costs, supply and demand, the gross domestic product, inflation and interest rates, business cycles and economic indicators, fiscal and monetary policies, and exchange rates.